Hey everyone, welcome back to the channel. Today, we're pulling back the curtain on something most of us have in our wallets, the credit card. It feels like a simple piece of plastic, a convenient tool for buying things. But what if I told you its story is far more complex, a tale of power, control, and a system designed to keep you in debt? Let's uncover the secret history of the credit card and how it evolved into a billion-dollar trap. It all starts much earlier than you might think. Before plastic, there was paper. In the late 19th and early 20th centuries, some large hotels and department stores issued charge plates, or shoppers' plates, to their wealthy, trusted customers. These were simple metal plates, often with the customer's name embossed, allowing them to defer payment until the end of the month. The key here is that it was a system built on trust and exclusivity, limited to a single store. There was no interest, just a convenience for the elite. This wasn't about creating debt. It was about fostering loyalty with high-value clients. The idea was simple. Make it easier for rich people to spend more money at your establishment. The real revolution began in 1949 with a man named Frank McNamara. The story goes that he was at a business dinner in New York City and realized he had forgotten his wallet. To avoid embarrassment, he signed for the bill and promised to return and pay the next day. This moment sparked an idea. What if there was a single card that could be used at multiple restaurants? A universal charge card. In 1950, he and his partner, Ralph Schneider, launched the Diners Club card. It was initially made of cardboard and was accepted at just 27 New York restaurants. This was the first multi-purpose charge card. You paid an annual fee, used the card, and settled your entire bill at the end of the month. Diners Club made its money from the annual fee and a small commission charged to the merchants. Crucially, it was still a charge card, not a credit card. The expectation was full payment. There was no revolving debt. The game changed completely in 1958. This was the year the modern credit card as we know it was truly born, thanks to two major players, American Express and Bank of America. American Express, already a giant in travelers' checks, launched its own charge card. But the real earthquake came from California. Bank of America launched the Bank AmeriCard. This wasn't just a charge card for dining and travel. This was intended for everyday people and everyday purchases. And it introduced the most transformative and dangerous feature of all, revolving credit. For the first time, you didn't have to pay your bill in full. You could carry a balance from one month to the next, and for that privilege, you would pay interest. This is the pivotal moment where convenience began to morph into a system of debt. To kickstart their program, Bank of America did something unthinkable today. They conducted a card drop in Fresno, California, mass mailing 60,000 unsolicited, pre-approved, and active Bank AmeriCards to residents. It was a financial experiment on an unsuspecting public. People who had never asked for a line of credit suddenly had one in their mailbox. As you can imagine, the initial results were chaotic. Fraud was rampant, and defaults were high, with over 20% of accounts becoming delinquent. The bank lost millions in the early days, but they saw the bigger picture. They weren't just selling convenience anymore. They were selling debt itself. The interest payments from those who couldn't pay in full were incredibly profitable. They learned that the money wasn't in the responsible users who paid off their balance each month. The real profit was in the interest collected from those who were trapped in a cycle of minimum payments. Seeing the massive potential, other banks wanted in. But creating their own system was expensive and risky. So, in the mid-1960s, a group of California banks formed the Interbank Card Association, or ICA. Their goal was to create a network that could compete with Bank AmeriCard. This network would eventually acquire the MasterCharge brand, which we now know as MasterCard. In response, Bank of America began licensing its Bank AmeriCard system to other banks across the country and around the world. By 1976, this network of licensees was so vast and international that it was rebranded to something more universal, Visa. And so, the two titans, Visa and MasterCard, were born. They aren't banks themselves. They are payment processing networks that connect your bank with the merchant's bank, taking a small slice of every single transaction. This new system fundamentally rewired our relationship with money. For centuries, spending was limited by the physical cash you had. Debt was often seen as a moral failing, something to be avoided. But credit cards changed the psychology of spending. The friction of handing over physical cash was gone, replaced by a frictionless swipe or tap. Studies have consistently shown that people are willing to spend significantly more when using a card compared to cash. The pain of payment is delayed, disconnected from the pleasure of purchase. The banks and credit card companies understood this psychology perfectly and marketed their products not as loans, but as tools of freedom, status, and empowerment. Don't leave home without it. It's everywhere you want to be. The messaging was brilliant. It framed debt as access and aspiration. Now, let's talk about the modern trap. The system is engineered for profit, and that profit comes from interest and fees. The concept of the minimum payment is a masterstroke of financial engineering. It seems helpful, a low bar to clear when money is tight, but making only the minimum payment is a surefire way to stay in debt for years, even decades, while the interest compounds exponentially. A small debt can balloon into a mountain. Then there are the fees: late fees, over-limit fees, annual fees, cash advance fees. These penalties are designed to extract maximum value, especially from those who are already struggling financially. The system creates a cycle where the people who can least afford it end up paying the most. Furthermore, the credit card industry has created an entire ecosystem of control built around the credit score. Your FICO score, a number that rates your creditworthiness, now dictates so much of your life. It's not just about getting a loan anymore. Landlords check it before renting you an apartment. Insurance companies use it to set your premiums. Some employers even check it before hiring you. This number, largely determined by your history with debt, has become a gatekeeper to financial and social mobility. It forces participation in the debt system. To build a good score, you often need to take on and manage debt responsibly. It's a paradox. To be trusted, you must first go into debt. So, what started as a convenience for the wealthy has evolved into a global system that generates billions in profits from consumer debt. It has normalized debt, changed our spending habits, and created a powerful mechanism of financial control. This isn't to say credit cards are inherently evil. Used responsibly, paid off in full every month, they can be a useful tool for security, rewards, and building a credit history. But it's crucial to understand the system you're participating in. It was not designed with your best financial interests at heart. It was designed to be profitable, and its profitability is directly linked to the interest paid by millions of people. The secret history of the credit card is a story about the monetization of debt. It is a reminder that the most common tools in our lives often have the most complex and powerful histories. Understanding this history is the first step toward using these tools wisely and avoiding the traps they've laid. Thanks so much for watching. I hope this gave you a new perspective on that little piece of plastic in your wallet. If you found this video insightful, please hit that like button, subscribe for more deep dives, and share your thoughts in the comments below. See you in the next one.